Thank you, dear members, for joining in for Tuesday evening for this session, which is relating to taxation in UAE. So, Akshay, you're present, right? I would request Akshay Hundia to introduce the speakers, please, for today. Thank
Good
you.
evening, everyone. Today we are venturing into a new field by CA Janak Panjuani. CA Janak Panjuani is a qualified chartered accountant who has been in Dubai for the past 30 years. Currently, he is a director in Putran Chartered Accountants, Dubai since 2000. CA Janak possesses knowledge, technical skills, and professional know-how in the field of auditing, VAT, ESR, transfer pricing, and international taxation. He has a keen understanding of subtle aspects of international financial reporting standards. He has also been served as a treasurer of Indian Business Professional Council, Dubai, committee member of a Dubai chapter of ICAI. He is an office bearer of various committees of BCAS, joint convener of Study Circle Committee of the chapter, and as the election office of Dubai chapter of ICAI. CA Janak has been a speaker at many professional conferences and he has written many articles in professional journals. With this brief introduction, let's welcome CA Janak Panjuani. And this is a very important note. He has also been a member of Jambu Study Circle and is a past deputy convener in 1990, along with CA Nilesh Vikramse. Thank you, sir. Thank you for joining this evening. So
Thank you. Thank you. You will like to introduce Rajiv bhai also, or when
right
Rajiv
now,
takes?
When he'll take place.
Okay, fine.
Fine. Yeah.
Okay. My screen is visible?
Sir.
No. Okay. Now screen is visible? No.
No, sir.
No. Oh. Just 1 minute. Now?
Yes.
Okay. Thank you. Okay, friends. Thank you for your kind word of introduction. And it is my proud privilege to be back with my Jambu Study Circle and give my views and my understanding on this very important aspect on this UAE corporate tax. Friends, we have taken the reference for today's webinar from the three things. One is the taxation of a corporate decree law, this and public consultation document, and Ministry of Finance frequently asked questions. Friends, announcement of corporate tax in UAE was done in January 22. Public consultation document came in April 22. And based on the public consultation document, various representation was done by various authorities. And then after considering the various representation done, the city law was published in official gazette on 10th of October 22, 10th October 22. Then it becomes effective after 15 days of publication in official gazette, that is on 25th October 22. This date of 25th October 22 is very, very important. Of course, we will explain when we take GAR provision. But GAR perspective, GAR is applicable with effect from 25th October 22. That point needs to be kept in mind. So as we are talking today, the GAR will apply to any arrangement which are being done with a sole purpose of saving the corporate tax. And CT, corporate law, came in the public domain on 9th of December 22. So this is how it has moved. Ministry of Finance gave the corporate tax FAQ also along with the publication of CT in public domain, that is on 9th December 1922. Then friends, it's worthwhile to know the steps for compliance in the which UAE has done over the past 5 years or so. On 1st of January 2018, VAT was introduced here. On 16th of May 28, the UAE has become the 116th jurisdiction to join the inclusive framework of the BEPS. On 23rd of September 2018, AML and CFT, anti-money laundering law, was also came into statute books. From 1st January 29, CBCR, country by country reporting requirements applicable to many headquarters companies in the UAE. On 30th of April 2019, economic substance regulation were brought into statute books. On 28th of August 2020, there was regulation on the ultimate beneficial owner declaration, which various regulatory authority took the declaration from all the licenses people that who is the ultimate beneficial owner of this company. And now going forward in 2023, the corporate tax will be implemented with effect from the financial year starting on or after 1st June 2023. So you can see gradually and steadily, the UAE has moved from so-called tax haven to tax jurisdiction for preventing harmful tax practices and bringing the tax transparency. This one slide, which is references from OECD itself, and OECD is saying that there are substantial similarities between the technique used to launder the proceeds of crime and to commit tax crimes. So this is very important observation made by OECD. And one more thing which they are saying, that 2/3 of all illicit flow involve tax evasion. So we need to be careful on this aspect, because as we all know, tax planning is permissible, but tax evasion is not allowed. Then, as we already know, that AML compliance is already done with effect from 23rd of September 2018, and government further give this AML compliance and framework for DNFPB, which is designated non-financial businesses and professionals. So in which the first and foremost is auditors and accountants. So all of us which are doing auditor, accountant, or company and trust service providers, they are all covered by AML compliance and framework network. So we have become additional gatekeepers. Also, responsibility is casted upon us, and we need to do KYC, customer due diligence, reporting of suspicious transaction, reporting to the concerned authorities, and we need to be compliant, AML compliant, before accepting any work. So this has to be very, very kept in mind, particularly as we saw that tax crime and money laundering have a very good connections. Coming to the corporate tax, friends, here there are two levels of taxation. One is the emirate level corporate income tax, which is levied as of now also on foreign banks and businesses which are engaged in extraction of natural resources. These two tax on these two category of business, various emirates, which are UAE is a country where there are 7 emirates, which you can consider to the India as a state, respective states of India, and they are levying emirate level corporate income tax on these two businesses. Of course, there are various free zones which enjoy corporate tax holidays as per the decrees issued by the relevant free zone authorities. It is something where I can compare it with the US, where the US also levies state level tax and federal tax. So emirate level taxation is a state level tax, and corporate tax, which we are going to study together, study today, is a federal tax. When the public consultation document came, and so they laid the foundation that these are the four guiding principles on which the UAE city regime will perform. And first and foremost is the flexibility and alignment with modern business practice. Friends, taxation of digital economy, which is going very well. So that nexus-based taxation, which they are going to, as we will look in further, that nexus-based taxation, they are going to come out with a cabinet decision and let us know. And various places in the law, it is mentioned that cabinet decision will come. So they have made, it is something like, as I corresponded with the CBDT circulars. So all chartered accountants or anybody who is practicing CT, corporate tax, needs to be aware or keep track of various cabinet decisions which are going to be issued time to time by federal tax authorities. Secondly, certainty and simplicity. They are saying the business should understand their obligation and make the right decision, and compliance costs are minimized. Rajiv bhai will take us through like small business relief and etc. various reliefs which are given under the corporate tax regime. Neutrality and equity are another principle. Transparency is another. These are four cornerstones which Ministry of Finance has said. Now, question which comes to our mind, that why UAE is introducing the corporate tax. Friend, the Ministry UAE is introducing the corporate tax for the two main reasons: be a tax transparent country as well as preventing harmful tax practice. And it is then when the corporate tax regime will become effective, it is, as I told you, the city regime will become effective for financial starting on or after 1st June 2023. And it will be applicable. UAE allows various accounting years. It is not like Indian Income Tax Act, where you have to keep the financial as 1st April of the year to 31st March of the next year. Here, entities can follow any financial year. They don't want them to change also. If somebody is following July to June year end, then corporate tax will be applicable from 1st July 23. Somebody is following calendar year, then it will be applicable from 1st Jan 24. And like I said, somebody like subsidiaries of India or otherwise following April to March year end, then the corporate tax will be applicable from 1st April 2024. One more thing, there is no registration deadline as have been given. Ministry has yesterday only came out with the procedure on the how to register on the portal of FTA. Then comes, what are the corporate tax rate? There are, for all other entities other than the qualifying free zone person, the corporate tax is 0% on the AD 375, which has been clarified by cabinet decision. So 0% of tax up to 375,000. Any income above 375,000 is 9%. So there are only two rates, 0 and 9. 0 up to 375, 9% above 375,000 of income earned by any other person than the qualifying free zone person. Coming to the corporate tax rate for the qualifying free zone person, they are saying 0% on qualifying income. Question arises in our mind, what is the qualifying income? Friends, that is going to be come out, or Ministry of Finance will come out cabinet decision stating what will be the qualifying income, and 9% on taxable income, that is not a qualifying income. So now anything which is not qualifying income, there is no basic slab of 375,000. So even if you earn an income of 1 dirham on a non-qualifying income, you will be liable to tax 9% on that 1 dirham. So this is applicable only for the qualified free zone person. All other persons, 0% up to 375, more than 375, 9%. And one more thing, that multinational enterprises who are subjected to, means MNEs who are having a turnover of more than euro 750 millions, will be subjected to above rates 0 and 9%. If they are other unqualifying person, 0 and 9% above not qualifying income. So MNE will be subjected to above rate till Pillar 2 rules are adopted by UAE. And this has been clarified by FAQ 118 and 157. Now, let us come to resident person. Resident person is any juridical person. Juridical person means incorporated or corporates that is incorporated or established or recognized. Question comes, why recognized word has been used here? So recognized word has been basically to cover the cases of migration of company from other tax jurisdiction to UAE. So any company which is incorporated in UAE, otherwise established in UAE, or recognized in UAE state legislation, including free zone companies. Second, very important, juridical person that is effectively managed and controlled in the state. So if the company is effectively managed and controlled from UAE, then it will be considered as a resident person. What is effectively managed and controlled? It is something like Section 6 of the Indian Income Tax Act, where they have came out with the definition of POEM, etc., place of effective management. So that same concept will apply here. So that is the what second category of resident person. Natural person, that is individual, who conducts a business or business activity in the state. So all individual who are carrying out business and business activity in the state, that will be considered as a resident person. And any other person as may be determined in a decision to be issued by the cabinet. As we just saw, natural person, UAE city regime will be implemented without a parallel tax on the income of a natural person, that is individual. So which income of individual will not be subjected to tax? So that will be employment income, dividend income, and investment income. Friends, please note, if individual is carrying out business or a business activity, then it is liable to corporate tax, and this which business or business activity will be covered by the corporate tax law of UAE. This will be specified as per the cabinet decision as per Article 11 subclause 6 of the law. Friends, it is worthwhile to know this is name of the law itself is Taxation of the Corporation and Businesses. It refers tax on business irrespective of who is carrying out the business. So it leaves us with the two important definition, business and business activity. So definition of business is any activity conducted regularly on an ongoing and independent basis by any person. So if any activity is conducted regularly and on an ongoing basis, then it will be satisfy the definition of business. And what is business activity? Any transaction or activity or series of transaction or series of activity conducted by person in the course of its business. So even single transaction, if at all a very high, whatever it is. Business activity definition covers a single transaction as well. Then what or who are the non-resident person? Non-resident person is a person who is not a resident and has either a P, permanent establishment in the UAE, or derives a state source income from UAE, or has a nexus in UAE. Nexus P is defined or explained as per Article 14 of the law. State source income is explained in Article 13 of the law. Nexus is not mentioned. It will be specified as per the cabinet decision. Okay. Now, it leads to a very important definition of a permanent establishment. So what is permanent establishment? PE is a place of business or other form of presence in the state of a non-resident person in accordance with Article 14 of this decree law. Friend, it is worthwhile to know that this definition of PE is aligned with the definition in the OECD Model Tax Convention and the guidance of PE provided in OECD commentary on Model Tax Convention can therefore be used as a reference when assessing whether a PE is created in UAE or otherwise. So we need to study OECD and majority in case of country UAE, all their double tax avoidance agreement are drafted in accordance with OECD Model Tax Convention, and therefore the guidance of PE provided in OECD commentary on Model Tax Convention will be useful while determining the PE is formed in this part of the world or otherwise. Then permanent establishment, this will trigger a PE in two cases. One is fixed place of business test or dependent agent test. These are the two P's which are already covered. Service P as of now is not covered. Service P is a concept from UN Model Tax Convention. It is not covered as of now, but maybe, as we have already understood in here, point C, the nexus in the state to be specified in a decision, cabinet decision. So maybe service P may come once the cabinet decision specifies the other P determination tests. What is fixed place of business test? The fixed place of business will include a place of management where management and commercial decisions that are necessary for conduct of business are in substance made. These are very, very important terms. And therefore, we need to be very sure while conducting the fixed place P rules that key management and commercial decision, which is a decision test, then that are necessary for conduct of business, which is a necessity test of an entity as a whole, pervasiveness test, are in substance made. This is substance test. So all these four tests, all above condition are to be satisfied during the relevant year, or as we call it, relevant financial year. So a company may have a fixed place P in one assessment year, but it may not be having a P in the next assessment year. So it is, we need to be, this P determination test has to be carried out on a year-to-year basis. And second is a branch or an office or a factory or a workshop, land, building and other real property. So premises which are taken on rent will also satisfy this condition. And premises must be at a disposal of foreign company. These two tests also needs to be kept in mind. installation or structure for exploration of renewable or non-renewable natural resources, a mine, oil or gas well, or a quarry, or any other place of extraction of natural resources, including vessels, structure used for extraction of such resources. So these are all covered as a fixed place PE test. Last is a construction PE test, that is a building site or a construction project or a place of assembly or installation or supervisory services in connection therewith, but only if such site, project or activity, whether separately or together with other site, project or activity, lasts more than 6 months. Very important, lasts more than 6 months, including the connected activities that are conducted at the site or project by one or more related party of the non-resident person. Here, friends, what is important is that, sorry, 1 minute, that if you are, because this is a 6 months period which is mentioned here, and if you are going to do, if the project is for, say, for example, 8 months or 9 months, M&E project, and you divide this project into 2 related parties, one related party doing certain works on the project for, say, 5 months, another related party doing on the project for 4 months. So it is artificial avoidance of P, and they are saying that will not be covered, because that is the reason why they have used the word project by one or more related parties of the non-resident person. So this all needs to be kept in mind while determining the fixed place business test. Now, even though you have the fixed place P, but activity, if the activity is of preparatory or auxiliary in nature, that is activities which are performed, which are limited to marketing, promotional activity, performing market research, or attending seminar or convention. This all will be our activity of preparatory and auxiliary natures. Then it will not constitute fixed place P. And a fixed or permanent place of UAE is used only to store or display or deliver the foreign company's goods, or keeping stock of goods with the sole purpose of making them available to another person for processing. So these are the 2 exclusions from the fixed place PE rules. Second is, mere presence of a natural person in the state will not create a permanent establishment of a non-resident person, provided that natural person is not carrying out a core income business generating activity of the foreign resident. Further, as already explained, that anti-fragmentation rules are already there. That is, fragmentation of business activities are not allowed as per Article 14, subclause 4, and reference has to be made to double tax avoidance agreement for determination of P, or whether that company is carrying on preparatory or auxiliary activity, which has been clarified by FAQ 67. Friends, at this stage, it will be worthwhile to note the difference between P as well as poem. Poem is a concept, as we understood, in the residence state, which was coming here. A juridical person established, incorporate or otherwise established in the applicable legislation of foreign jurisdiction, and that is effectively manage or control in the state. So when there is an effective management, then you have to comply maybe with the, and P is formed in the both the location or both the countries, maybe in India as well as in UAE, in which case you will have to make application to the competent authority, which by way of a mutual MAP, and then they will decide where is the place of effective management, and accordingly they will have to file the taxation and everything in that country. Important thing for the POEM test is that manage your affairs in such a manner that you create a POEM, place of effective management, in one country, so that we don't have to go with mutual agreement procedure, etc., etc. Because otherwise a double tax avoidance agreement treaty benefits may not be allowed, and it will create so much issues. So it is always advisable that to decide and fix the POEM in one country. Coming to the branch or permanent establishment, then undertaking, you need to be very clear. The compliance will be in both the countries. That here, suppose a fixed place P is in UAE, then you have to comply with the UAE as well as whichever the country you are also resident, and you will be entitled to treaty benefits and foreign tax credit benefit. Coming to the dependent agent test, in absence of fixed place of business in UAE, the activities of so-called dependent agent in the UAE still create a PE for a foreign company in UAE. Fixed dependent agent test may be met where the business travelers or UAE-based person act on behalf of a foreign company in the UAE and habitually exercise the authority to conclude the contract in the name of foreign company. So basically, if a person or a company is concluding the contract in name of foreign principal, manufacturer, suppliers, we need to be very clear, and there are no significant variation between once the contract is negotiated by UAE company or UAE agent, then it may become a dependent agent P in the state. It also be worthwhile to know that if an agent is making so many distribution for so many principal and everything, and then it may become an independent agent, exclusion will apply. But this so-called independent agent exclusion will only apply where the person does not work exclusively for foreign company and is truly legally and economically independent from the foreign company. Legally fine, but economical independence is very, very important to be determined here, that it has a financial capacity. It is not that this company in part of UAE is 100% financed by the loan by the way of a foreign company or etc. And 90% or more than 90% of the business is being carried out of that principle only. See, these are the practical scenario which we need to study case by case basis. And this has been also specified by FAQ 45 of the frequently asked question, where determination of P needs to be done on case-to-case basis. Very clearly mentioned case-to-case basis. So it is important to analyze agent and principal relation before coming to a conclusion whether it is a dependent agent or an independent agent. That comes to, we are coming to UAE source of income. When a company earns UAE source of income and that does not have a PE in the state, but that will be subject to withholding tax at rate of 0%. Friends, you will appreciate 0% rate is also tax and may be classified as subject to tax. This is very important for claiming double tax avoidance agreement, treaty benefits, etc. So UAE city has a specific rule and guidance to determine whether income has been sourced in UAE. So if payment is attributable to PE in UAE, then it will be considered as a UAE source income. If income is derived from activities or contracts which are performed in UAE, or assets which are located in UAE, or right use for economic purpose in the UAE, that will give us what are the UAE source income. One more thing which you should know is merely earning of UAE source income will not trigger CT payable as of now, or require the foreign entity to register and file income tax return, as they are subjected to 0% withholding tax as of now. And this has been also clarified by FAQ 68 and 69. If the withholding tax increases to 1%, then this position will change, that they will have to register, they will have to file the tax return also. So state source income is where it is derived from a resident person. So if the payer is a resident person, it will be state source income. If it is derived from non-resident person and the income received has been paid or accrued in connection with and attributable to P of that non-resident person, if UAE resident is a UAP is a payer, and third, where it is otherwise accrued in or derived from activities performed or asset located or capital invested, right use or services performed or benefited in the states. Now, subject to any condition and limitation, minister may determine. So further, they can give, minister cabinet decision can come, and they have given example of various things which will be considered as UAE source income, which include sale of good, provision of service, income from movable or immovable property located in the state, income from disposal of share or capital of a resident person. Most important, one thing which I would like to bring to your attention is interest that makes following condition. Loan is secured by movable or immovable property in the state. So say take an example where the borrower is non-resident person, lender is also a non-resident of UAE. Only the property is located in UAE, maybe movable or immovable property, and interest which is earned by a lender in such a case will become, as of now, UAE state source income. Of course, it will be subjected to tax, but withholding tax is only 0%. So nothing to worry as of now, but it's an interesting scenario which they have brought here. And friend, FAQ 75 clearly mentioned that whatever list we have made in Article 2, they are non-exhaustive list of income that is considered as being source in UAE. Further, they can add. Otherwise, we as a consultant needs to establish or see whether UAE source income has been made or otherwise. Thank you very much, friends. Now, further thing, Rajiv Bhai will take over, and I will further, once again, I will come when Rajiv Bhai talk is completed. One more observation which I would like to make, that there is no obligation to file withholding tax return, TDS return, because TDS rate itself is 0% as of now. Thank you, friends. Thank you for as of now.
Thank you, sir.
Akshay.
Thank you. Can you hear me?
Yeah.
Thank you, sir. Thank you, sir. Any questions, members? So let us start with the next session by Rajiv, sir. Rajiv Hira is a high caliber finance professional with an experience of leading roles in private and multinational financial institutions for over 25 plus years in the area of risk management, compliances, investment analysis, investment management, taxation advisory, and management consulting. He has an expertise in connecting with people and process to arrive at the effective value proposition for the business, derived from hands-on experience of working in multicultural and multinational organizations. He also has an experience of working in Asia, Africa, and Middle East. Right now, he is actively involved in UAE with large corporates, SME, and individuals on indirect tax implementation advisory and transactional advisory. He has contributed in development of resources with other professional bodies, training institutes, and corporates through structured trainings, seminars, and articles. He also has a hands-on experience in engaging with regulators and governing bodies in the space of anti-money laundering and counter-terrorism financing. This work involves understanding the strategic intent and implementation objectives for compliances. Rajiv sir, we welcome you to this seminar to this evening. Sir,
Thanks,
please
Akshay.
carry.
Thanks, Akshay,
Please,
and thanks team
yeah.
for inviting us.
Yeah.
So I'll just maybe refresh some of the thought process that Janak ji was also referring to. And I think this is the most important question which we keep hearing from our Indian counterparts. So whenever we we keep getting, so we straight away work with Indian chartered accountants also on how to set up the structures in UAE, what to do from a accounting, taxation, and other perspective. So I think P is taking an important role. We know from India perspective, POEM is quite sensitive as that tax authorities have started looking at IP rights also from where the email or communication has started. So something similar we should be eyeing from a UAE perspective also. So P is becoming one of the aspects. As Janakji has already told how the journey has evolved from 2018 till 2022, and as we talk in 23, the major shift or the major game change which is happening, which is a corporate tax. So I think the biggest alignment, I will say, which India and maybe UAE has to look at is how we can ask questions and get into a right space between the professionals. To be honest, I was talking to Akshay and team before also. I don't think anyone can teach law to Indian chartered accountant. They are much more equipped in reading the law, understanding the law, and getting into the depth of what is written. I think the most important part comes with how UA is unique from an India perspective. I think that's where the challenge, or I will say, the new learning can grab up. You will never hear. You will never hear that any chartered accountant from India perspective faced a challenge to understand how the UAE law is there. But definitely how the structures of UAE is evolved, that's the most important part. And I'm going to cover some of the intricacies majorly from a free zone perspective, which is being looked at. But moving to, I'll pick up from the points which Janakji has left, and I'll encourage everyone. It's a small group, and we are all learning people. I don't think anyone is here to teach anyone. It's more to see how we can share our knowledge and grab some kind of a bullet points, or maybe you can say the depth from India perspective. To be honest, we are still looking at transfer pricing to learn from India. No one else can do better than what India has done on the TP framework. So that's where the space comes into. Moving to the pointers which Janakji has picked up, I'll just take a quick snapshot of how things are evolving. UA is not going to have a tax on individuals, so that's the first point, which is quite open. They are not looking at taxing anyone who is in the salary income or who is having some kind of investment income. Now, when I say investment income, it has a very different tangent to look at. Investment income as an investee or as a trader. Now, there are two aspects which can come into. If you're an option trader or you are doing a day trading or you are doing any kind of a margin trading, then technically speaking, in the global world, we have seen that goes and sits on the business side. So what will happen if an individual is doing something similar from a UAE perspective? Individual, like as a Rajiv Hira, I go to a broking house, I take a trading account, and I do a US options or or any international market options, will that be considered a business or not? So far, interpretation is coming as yes. So those are quite near to factors which are need to be looked at. There is a lot of open points which are still there as we talk from a natural person perspective. Law does not say that all the natural person is exempt. If they do any business in UAE, that is where the taxability story comes into play. Second part, which is unique from a UAE perspective, every business is required to obtain a trade license or a working license to operate in UAE. So no one can just come and start the business without having a requisite approval from the authorities or obtaining a trade license. So that's also one of the unique feature which comes into what if someone is doing a business without obtaining a trade license? Will that be considered as a natural person or should be considered as a business income? I think again, coming back to the business income story. And so the law has very clearly said it's a registered or a legal entity or unincorporated entity. Everything comes as part of it. So far, we are doing a business in the definition of a business category. Threshold is quite huge. So if you see up to 375,000 dirhams, which is approximately 85 lakh rupees plus minus, is what we are talking about, which is going to be exempt. So there is a question. I will just pick up those points also so that it goes into a right aspect. So Sumit is saying if 9% tax is still lesser than overall limit of 15% worldwide, that too they are still not taxing individual salaries, etc. So what is the purpose of corporate tax regime? Sumit, perfect question. I think the answer lies in the space on BEPS framework or a money laundering framework. Let me put it very straight through. If you look at a journey which Janak ji has evolved, I'll just take you through maybe that journey in a couple of minutes more and put up some dots to what and why these things are coming up. If you look at a whole journey, I don't think this journey is not connected. It's completely connected to the corporate tax, what we are talking about. When value-added tax came, I'll just give some numbers also. The first year revenue was expected to 12 billion dirhams, and the super achieved it by 20 billion dirhams. So it's not about, again, value-added tax. If they have to just collect this much of money, there are so many other means to collect that kind of a revenue. I think it started from value-added tax was the starting point to make sure that how people start getting a habit of creating books. Before 2018, there was only a custom framework. That means when you import the goods, you are declaring, and after that, everything is completely aligned. And you are, I will not say 100%, but you are more or less do any kind of accounting, any kind of a bookkeeping, any kind of a income generation. And there was no second guess level or second documentation level, which is there to verify. When value-added tax came, you started looking at from a GST or VAT perspective, what India has seen a journey. You started looking at who paid input tax, who is claiming input tax, who is paying output tax. So there is a trail of transaction or audit trail of transaction we started building in. So that's our first framework. And immediately after that, if you see, UAE joined the BEPS framework, which is base erosion profit shifting framework. So that's where, again, coming from an AML OECD perspective, 2018 they strengthened the AML framework in a very big way. And from a UAE perspective, if you see from a UAE perspective, AML is quite stringent. Every auditor, when is doing an audit, or any corporate service provider, when he's bringing a new company to the UAE, they're supposed to do complete due diligence of each client, do their KYC, and I'm telling you, it's as serious as any financial institution doing a KYC from a country perspective. So if there is any miss, the penalties and fines are huge, apart from the personal liability also, which comes and plays a role. So this is again a very stringent law. CBCR, country by country reporting, that is anyway a global phenomenon, again touching from a AML perspective. Economic substance is pushing quite hard right now. So there were instances where people have set up offices. They are with a single desk or a small office, and you're earning multi-million dollars. So the question started coming in: what is the substance you have in UAE to generate the amount of profit you're generating? And second, this got connected with the reporting back to the other countries. So there are countries which are part of the treaty. 140 plus countries are there, where information from some of the critical activities. I'll just talk about one of the elements. If you are earning a royalty from an income, which is from a royalty product, which is not originated in UAE, and let's take that a parent is sitting in India, and it becomes a high risk intellectual property rights, and immediately those information gets passed on to the corresponding country from where the parent exists. That means there is a very clear link of base erosion, profit shifting kind of a scenario happening. 2020, again, a sea change we have seen where there was no beneficial owners known. Now you cannot even do an accounting, do an audit, or even set up a company if the warm body, that is the last leg of person, is not known. So that's becoming a new norm. So this is where the change has happened. My take or information is whatever is happening is not about a 9%, it's going to the international framework and complying to the AML story in the whole gambit. So it's not about the percentage what we are talking about, it's about getting into a compliance framework, which is the most important thing. And that's I think the most important part, and I'm glad you asked this question. If you understand why, then how and what need to be done becomes much more easier. So why is as simple as it's not about taxes, it's not about money, it's about the intention, it's about how the record keeping is done, it's about how the financial things are being maintained. That's getting questioned. Coming back to the slide which I just left out. So we are talking about a natural person. So as I said, natural person is not only if he's doing business or not. We have to look at whether he has a trade license or not, what kind of activity they are doing, whether it's categorized as a business income or not, whether licensed, not licensed, it may be taxable in the space. A very important part we have seen in UAE, a lot of time what we look at from a practical purpose. People from various countries come to UAE on a visit visa or a short visa, do the business, get some income earning, and then move back. Now, this is also becoming one of the showstopper from a tax perspective. There are two legs to it. Point number one, I talked about a natural person. So if a natural person is doing a business, he's supposed to be paying taxes. So whether he's a resident or non-resident, so that's not getting into. But if you are doing something in UAE with a P, then it comes into a place. Second part, look at from a business perspective. If business hires anyone uh, as a freelancer without having any trade license activity or without having a requisite approval, which is required from authority, those expenses will not be allowed. So those expenses will not be considered as a legitimate business expenses because you have paid money to someone who is not authorized to either work in that jurisdiction or is not eligible from the legal framework perspective to do it. So it's a double way story which is coming up. So coming back to a legal person, if it is incorporated and it has a P in UAE, will be taxed from a UAE worldwide income perspective. Definitely, you'll get a benefit of foreign jurisdiction taxes, subject to the 9% standards which are there. Natural person, they are not calling it to a global income, but they will be part of the UAE framework taxes. So you will not tax a natural person for global income, but for legal person, that's there. And foreign company also, if P is established, again, it coming back to the P, again, it will be a worldwide income and you can get a benefit of the taxes paid in other countries. So it's becoming quite critical on how the structures and operations and even how the holding companies are being created to ring fence and look at how the taxes are done. Moving to a very interesting clause which is being put up, which is there in a lot of tax jurisdiction we have seen, which is on transparent structure. So that means what they have done from a partnership perspective or any unincorporated joint ventures. So there is a provision where you can remove the structure and treat the second level of the entity as a taxation structure. Example, if two companies which have their own trade licenses, they work in their respective fields, they have acquired one project under a joint venture. That means joint venture, I'm not calling it a new company. I'm calling it unincorporated joint venture. That means company A and company B jointly did an agreement with a party. So it's a tri-party agreement. In this case, they said we will exclude the unincorporated entity and we straight away go to the respective company for the tax purpose. And similar thing will apply to the partnerships also. In a general, I'm not saying it's a completely 100% aligned, but in general, you won't find uh, limited liability partnership in UAE, except for one or two jurisdictions which allow them. Otherwise, maximum jurisdictions are into the LLC, limited liability companies. So that is where it comes into. Uh, Important points, you can use a transparency rule, which we talked about from a partnership perspective. Uh, Again, the apportionment of expenses, the alignment of expenses are also allowed and have to be done in the similar fashion. So it's a business income, it's a business alignment, and how things are being aligned, and assets and liabilities and P&L are being bifurcated. That becomes a little bit complicated, and we will look for how the cabinet decision comes in and gives more guidance on how those apportionments has to be done. Second thing which comes very interesting and handy is the family foundation. In this case, it's something different than the partnership, but more or less it's getting into the same picture. Here also they said if you have a family foundation, you eliminate, that means use a transparency rule, and you tax the individuals behind that. So there can be a benefit on account of family foundation because individuals are not going to be taxed for various incomes, if it comes from investment side or if it comes from any kind of passive income, if I just talk about in that way. But there are some conditions which need to be looked into. Now, in this case, family foundation cannot go by default into a transparency rule. They have to make an application to authority. So it's subject to approval. Point number one. Point number two, the condition is the foundation should have identifiable natural person. So that means UBO has to be known. You cannot keep it with the corporate and then leave it out. So that's not possible. So it should be either identifiable natural person or any public benefit entity. So that's also one of their public benefit entity can be kind of a pension fund which is working as a foundation or something which is going at a larger interest. So that is also being looked at. Second clause, what is being put up is they should receive, hold, invest, disperse, or otherwise manage assets or fund associated with saving or investment. That's when they are not allowed to have a regular business kind of a function. It's more a passive investment, and they should not constitute a business or business activity. So that's also part of it. Uh, Last clause, which is part of anyway GAR also, that it should not be made only for the purpose of tax avoidance. So that should not be the criteria which comes into. And so that's where it comes into. So foundation is an interesting factor in UAE. If I just compare from India perspective, trust, we can just do a little bit of mapping is equal to foundation, but it has a little bit of different structure from various authorities perspective. If you look at the financial regulators, they register the foundations as a legal entities, which is as good as a limited liability company's equivalent. And it's a proper structure with the legal identity, separate legal identity which comes into. So in those cases, getting an approval from the authority makes a lot of difference on how those taxes are applied. Because one thing we have to again rewind ourselves and keep re-emphasizing that individuals are not taxed. So in this case, if we remove the corporate wheel, that means we remove the foundation structure and come back to the individuals, there is a possibility that you may not be taxing any income which is originated as part of the business which is being tapped. Now, these are the conditions that it has to continue. It cannot change the structure and all those, which are byproduct or relief points which are being mentioned here. One of the Article 21 says there is a small business relief. Again, this is for entities which are not generating a profit of more than 375,000 dirhams. That is the threshold from taxable perspective. I should not be part of exempt category, not taking any special reliefs, uh, not having any tax loss reliefs which they are taking. So if they're a basic small business entity earning a profit of less than 375,000, they will get a relief. Now, what kind of a relief is this? Predominantly not creating a transfer pricing equivalent documents, not have to meet to the regulatory submissions, but definitely the authority has said that they need to maintain relevant information to make sure and prove that they are under the category of a small business. So the proof, or you can say the documentation requirement is still there, but it is being mellowed down so that it's not a burden from a small business perspective. There are various incomes which are being classified as exempt. One of the premise or broad factor I can say, they're not looking at a double taxation in any cases. So if you receive any dividend from a UAE company which has already paid a tax, then the dividend distribution on receipt also is not going to be taxed. Second point comes as a participating interest, which is there in the further slides also, but just to give you a big perspective. If you have an investment from a UAE to any foreign jurisdiction, your investment size is more than 5% of the share capital or the capital value, you have intention or have held that asset for more than 12 months. And the third condition comes is the profit distribution is at least 5%. So there should not be a differential shareholding where profit is not being given, but you hold the shares. So that should also not be there. And the income generated should not be more than 50% from an exempt category. So if all those three broad conditions are being met, then any dividend received from a foreign country where taxes of 9% or more are already paid will not be taxed from a UAE perspective when you receive in the holding company or in the foundation or kind of a parent company which is based in UAE. So that is a participating interest exemption which is being provided into. And there is one more condition which is especially for aircraft or ships in international transportation. Those are also going to be qualified under the exempt category, exempt income under Article 22. So there are going to be some further, you can say, prerequisites on how those incomes can be allowed into. I just talked about a participation exemption. So if you see clause number 2, this is where the gist of the actions are there, where it says you should own 5% or greater ownership interest. Now you call it capital share or whatever name refer to. And the holding should be for 12 months or more than 12 months. That's a prerequisite. Even intention to hold also can play a role. So if you have, let's say, purchase shares at the fag end of the financial year, still you can and you earn some dividend, still you can take it under the participation exemption criteria, subject to you say that I'm going to hold this for more than 12 months. Now, if you sell it before 12 months, then repercussions are huge. That means you have to claw back the benefits you have taken and pay taxes with a retrospective basis, so which may impact penalties and fines and other things also. Second point we referred to that 5% or more profitability participation should be there, and not more than 50% of direct assessed income should be on the exempt category. So this is comes into the participation exempt income. It's quite interesting to see how UAE is trying to still maintain the control or the holding structure with these exemptions, because if there is a double taxation, then people will start thinking of why we should have a holding company or a holding structure in UAE. So this is one of the visions which the country is carrying on, and they're giving a benefit on those lines also. So there are conditions if you don't meet, and all those it will be withdrawn also. So which are at a broad level. Giving you a snapshot of what we talked about so far. So if there is a domestic dividend which is earned from a UAE company which has already paid taxes on 9% and hold 5% or more share, then any income or dividend earned in UAE also or from a foreign company also will not be subjected to tax. So these are the parameters, or these are the judgment points which are coming out from a dividend or a capital gain perspective. So 5% is a threshold. So if you don't carry any more than 5%, then there's a different calculation, or you can say it will be subject to tax. This is for the holding company. Now, interesting structures we have seen. Now, how it need to be revisited is what we will see how the revisit of the structure is required. So if you see a UAE holding company holding a BVI company and further UAE company subjected to 9% tax. So this is how the parent company is a UAE holding company. Now, how you will tax it? So because if I say UAE company is a 9%, BVI is not, and when the BVI transfer the dividend finally to the UAE holding company, then I have a problem because I may be holding more than 5%. but BVI is not subject to CT. So there is a possibility that we are getting it double taxed here because we cannot take it to as a see-through transaction. So these need to be looked at, and even we need to see how these are being viewed from a cabinet decision perspective. Is there any kind of exemption which comes into? If not, then this is one of the challenges which we see on how the transactions are there. I'll just give a pause here if there is any questions from anyone. Let me look at. Perfect. So we can go ahead then.
Yes, sir.
Free zone is something. Yeah. So free zone is something a unique feature which is there in UAE. I'm not saying this is not there in other countries, but there are some good tax advantages, tax arbitrage, which are being looked at from a free zone perspective. Now, what is a free zone? Let's look at a broad perspective. Even direct tax and indirect tax. This is where we see that there are a lot of talking happening from between the direct taxes and indirect taxes. How those implications are going to be impacted from a corporate tax perspective also we need to see. A unique feature, Dubai has, rather UAE has multiple free zones, which are defined as a designated zones from an indirect tax perspective. Now I'll talk about first designated zone and we'll go to other free zones also. Now designated zone, technically, if I just maybe do a broad level mapping, we have from India perspective, we have export processing zones, where the tax holidays are given for certain aspect. So that's how UAE also has this kind of a structure where these designated free zones are custom bonded area, where if you bring the goods within the free zone or designated free zone, you can process it, you can manufacture it, you can reprocess it, you can trade it, you can do whatever you want to do. One within that free zone, and you supply it outside the country from that free zone. All those transactions are outside the preview of customs and VAT. So you end up not paying any custom duty, and you end up not paying any value-added tax or indirect tax also from that perspective. So even corporate tax also has picked up those pointers, and they have given references also to those pointers in UAE. The second category of free zone is which are not designated free zone. Now there are few financial free zones are there, which does not carry any custom boundary area because those are more service centers. So those free zones, a service center free zone does not have any demarcation from an indirect tax perspective. So anything which happens in the non-designated free zone are subjected to standard custom and standard VAT procedures and process. Now, what happens? The first challenge which we see, and I think we are expecting a decision from a cabinet perspective how this will be looked at. Every free zone has their own respective decrees or their respective laws which are being designed and defined, which says how many years of tax corporate holidays or tax holidays they carry. So if I just give you an example, we have picked up two free zones. One says 50 years, zero corporate tax, another says 40 years, guarantee for zero taxes. So now, whether it's for 40 or 50 years, we will be hearing that from the cabinet decision based on each free zone. What is the tax holiday which will be provided to those category of free zones? So that's an open point. We are waiting for how the decisions are being looked at. But broadly speaking, now we already have a designated zone definition from a VAT perspective, which is different than designated zone from excise perspective. Now one more definition which is coming up, attaching a free zone, which is qualifying free zone. So they have given a broad conditions as from a law perspective that what are going to be qualifying free zones. First, maintain adequate substance in the state. Now, if you look at the word substance is an important part which we have seen from a economic substance regulation also. Substance broadly qualifies to how much of office space, how much people, how much assets, and infrastructure we created for earning the profit we are earning or for doing the business what we are doing. So, and the adequate word is not a standard. We can classify that for earning 1 million, you need X square feet of office. So that's not even being defined that way. So we need to, this comes back to the SSE's perspective, how they prove that they are having adequate staff, adequate trained people, adequate premises, adequate assets, infrastructure, and all those parts which are there. So this is again coming back as we looked at from a substance perspective. Next comes derived qualifying income as specified in the decision issued by cabinet. So this is what we are waiting for. What we have done is we have picked up a public consultation document, and we have looked at or articulated from there what is being defined as a qualifying income in the public consultation document. So we're going to use a mix and match right now from a law and public consultation document to talk about the interpretation which is coming up. There is one more provision where they said, okay, you are already a free zone, you are qualifying free zone, but you want to go to the normal standard tax principle also. So that's also one of the interesting point. What happens is if you are under the standard corporate tax regime, then you get a threshold of 0% tax from 0 to 375,000 dirhams. And beyond 375,000 dirhams, you end up paying 9%. But if you are in a free zone, then this standard principle is not applicable. That means over there, incomes are classified into qualifying free zone income and non-qualifying free zone income or non-qualifying income. So for a qualifying income, 0% tax. For non-qualifying, you end up paying 9% from first dirham itself. That means first transaction itself. So there is no threshold, no 375,000 does not apply there. So I'll give you an example as we move along. And then complies to Article 34 and 55, which is more a transfer pricing and related party transactions. If all these things are there, then you can get into a qualifying free zone. There are add-on principles which will come from a ministerial decision as and when applicable. So that's where it comes into. I'll just jump into the straight away. We talked about those pointers. So from a law perspective, you see the corporate tax rates are classified into two buckets or two clauses. First clause is a general clause, which says 0% on proportion of taxable income not exceeding amount specified, which is 375,000 as we know now. The decision has come out. And beyond that, it's going to be 9%. But whereas for free zone, this 9% criteria is not coming. So if you see, if you're a qualifying free zone person, then qualifying income 0%, non-qualifying 9%. Now this qualifying income can be maybe a very small value. I'll just give an example. Let's say if you are earning a total 400,000 dirhams and your qualifying income is hardly 100,000 dirhams, then you end up paying on 300,000 dirhams 9%. But if you take a bucket in the first category, then you end up paying no taxes up to 375, and only on 25,000 you pay 9%. So that's again a critical decision businesses have to take, whether they want to go with clause 2 or clause 1 of Article 3. So this is again one of the decisions. They have left it to the assessing person, to the taxable person, to define it, how they want to get into. So free zone, two kind of income, 0 and 9%. So that's again we are repeating this because that's a quite a decision making activity which free zone has to look at. We are not certain whether this decision will be a yearly decision, or once you take a decision, you have to bind yourself for a few years. So that's an open point. So it's a irrevocable or revocable decision, and what is the period of revocability? We are not very clear from a law perspective. We have to wait for how the regulation or the cabinet decision talks about that. Now, this is what we said. You want to pay taxes in free zone. I think this can be a beneficial also. That's what we talked about. So that decision is coming from Article 19, which says that a qualifying free zone person can make an election to the subject of corporate tax at a rate of clause 1 of 3. So that's what we refer to. That means up to 375,000, 0%, and beyond 9%. Now, when it will be effective? Whenever you take an election from the tax period. Now, the closing point is what we are not able to connect the dots from a law perspective. We're waiting for more clarification on this part. On overall, at a high level, I will just say that free zones technically are not permitted to do any business with the mainland or non-free zone companies in UAE. Now that's a legal framework which is there. Now how it will be tightened, controlled, we have to see how this regulation or the corporate tax is going to impact the trading patterns also. So that's what I was referring to. It's not the legal framework, it's more the implementation framework and how those changes are going to impact the overall business actions or business takes which are there. Now what we're going to do is we are just connecting. So why we are referring again is we are using public consultation document because we don't have cabinet decisions or a rule book or regulation which is being defined. So we have a law and we have a public consultation document and the Q&A, which is what we are using it. Now, from a free zone perspective, we learned and we keep looking at free zones are outside the tax ambit, no taxes. That's a headline which is coming up everywhere, but that's not the fact, and that's not what is intended also looks like. One of the public consultation document 3.2 says very clearly. Now there is a word which we are picking up and looking for interpretation also. A free zone person can benefit from 0% corporate tax on income earned from. Now the first clause, that's point number A, says transactions with business located outside of UAE. Now these transactions can be a goods transaction, can be a service transaction also. And the clause B says, now from outside, it is clear if you are a free zone company and you're doing a service or you are doing a trading with the person outside the UAE, then those transactions may be subjected to 0% tax. But the twist comes in the point number B, which says that from trading with businesses located in the same or other free zone. Now, if you're doing a business within a free zone or with other free zones, so as I just talked to you, free zones are technically considered as outside the UAE geography from a tax perspective. But that's not what is happening from a service side. So if you see the point B is taking more from a trading and they've excluded the service. And that's what we said, how about service? So in this case, the service looks like be taxable, whether it's done within the free zone or between the free zones. That means if it is done within the geographical borders of UAE, any services look like to be a taxable at this stage. Whereas the goods have a privilege of not getting taxed because you can track it. It's not being consumed in UAE. So that's the way the benefits are getting derived or given from a 0% tax perspective. They've added up some more financial services also from a financial market perspective. So this is again UAE is looking at financial market domain area or want to be a prime center from a financial markets perspective. So that's where this is also looked like being taken out from a tax perspective, which was expected and is in the line of expectations also. Now some open points which comes again coming from a consultation. Free zone person has a branch in mainland UAE. So technically branches does not have a separate legal entity, but the law here says that if you have a branch in from a free zone company in the mainland, no issues. We will tax the mainland source income while you can continue getting a benefit of 0% on other income. So that's a relief or a benefit given to people or entities which has a free zone entity and a branch in the mainland. I'm not talking a reverse way because the core activities where it is being looked into. There are instances where you have a free zone company which can be a holding company, but you hold the assets or you hold the subsidiaries in the mainland. So here also we talked about if you already paid taxes, then any dividend will not be subject to tax. Second thing is if you see they talked about a passive income. So if income is only a passive income, then also the taxes will not apply if it comes into the between the free zone and mainland. So that's a benefit which is given. Now group transaction. Now this is nothing to do with branch. You have group companies. You're having a transaction with the free zone. They put a nice condition. I think this is quite practical and right approach also. The free zone company will still be qualified under 0% if there are transactions done between free zone and mainland. However, they said for a mainland company, any payments you made to a free zone company will not be allowed as deductible expenses. So that means you end up paying taxes in one location. So you cannot shift the profit. So that's where the control has come into. If you are doing a transaction between free zone and mainland, perfectly fine. Free zone will not say anything, but for mainland, any payment you made to the free zone will not be allowed as a deductible expense. So you have to write it back, pay 9% taxes on that. And the transaction is at least taxed once. So you cannot evade the concept. This is a point I was referring to, a nice connect between indirect and direct tax we have seen here, where it is said that if the transactions are done and how the transactions are done, that's becoming an important part. A free zone company, if sells to the mainland, now we have to look at who is importer on record. So that becomes the crux of the transaction. So if importer on record is a mainland company, then from a free zone perspective, they have sold the goods as a warehouse sale. So it will not be subjected to any implication from a corporate tax perspective. But in case a free zone company has used their import code and sold the goods to UAE, mainland company, then the problem happens, and this transaction will be classified as a non-exempt, non-qualified income and may be subjected to tax. So I'll pick some example. I think that's a right approach to look at from a free zone perspective, which will give you more clarity on how the transactions are executed. Now, this is an interesting thing which we have seen. When the public consultation document came, it said if any mainland source income is received by the free zone, we will remove the 0% corporate tax regime from the all income. So that means any one transaction would have disqualified the free zone for getting a benefit of 0%, but that got replaced from a law perspective, and they transferred and said that, okay, free zone company can have income, qualifying and non-qualifying income. For qualifying income, you keep getting the benefit of 0%, 9% will be for non-qualifying. This was a sea change which we have seen between the public consultation and how the law has come up. So the example which we have given is more to show you how the impact has changed from a PCD to the law. One thing which is still challenging and we need to look at is we may have different income, 0% and 9%, but how the apportionment concepts will be used. Because you may have some expenses which are directly related, perfectly fine, but there are a lot of expenses which are going to be indirect, common expenses. Now, how those apportionments will be done. So that's a open point, and we need to look at how those will be addressed in the ministerial decision and the cabinet documents which we look at. Quick example, just to give you a hands-on experience of how those transactions can be looked at. So quite an interesting space on how UAE has evolved and come into the quite a best practices from a tax perspective. The case goes as simple as that. DZ, if you see on the right side, is the UAE company, UAE jurisdiction, and I have a designated zone company, which is a free zone. We are importing coffee beans from Africa continent, which is coming directly to designated zone in the bulk. Now, in this case, since goods are purchased from rest of world to designated zone and are held under customs suspension, those are the facts we are giving you. If it's held under customs suspension, that means it's not meant for a local consumption. Customs suspension means you import the goods for the purpose of re-export, even before processing, after processing, all those criteria can happen. So this whole transaction or whole action is technically qualified under will be part of the qualifying income, which will be looked at. I think I missed it on. Yep. So the whole income in this case will be classified into the qualifying income category and will be subjected to 0% tax. No challenges on this part. Now let's take the scenario 2, where we got the coffee beans, we processed it, we toasted, roasted, and all those things are being done. And we have got the final product, which is some 500,000 packets of 50 grams. So now all those things are done. Still the goods are being processed within the designated zone, as what we talked about under the tax economic zone. Designated zone is a word which we are using, which is more prevalent from a VAT perspective. This transaction will also be considered as within the qualifying income criteria, and all these transactions are still within the 0% category. Now, what we did, we transferred goods from one designated zone to another. So again, there are multiple free zones, pre-designated zones, that means from a VAT perspective, which are defined. So if I transfer goods from one location to another under the customs suspension, that's the underlying statement. That means goods are still not available for local consumption. This is still will be classified under 0% category under the qualifying income and will not be subjected to 9% tax. Now, the headline statement which we keep hearing, any free zone income is outside the preview of a corporate tax. That's what I'm going to break from this scenario. So if you look at within the free zone, we have a coffee shop. Now, what we did, all the packets which we produced in the production plant, we transferred a couple of packets to the coffee shop within the free zone for the consumption. That means the coffee shop will open those packets, process it, and serve as a restaurant to the people. In this case, these goods are now designed for a local consumption. The moment the goods are designed for local consumption, we need to pay the custom duty. The moment you pay the custom duty, VAT implication will come into picture. And the moment you pay the VAT, although you are in free zone, you may have some designated goods which are meant for local consumption. And in this case, the transaction will tantamount to not a qualifying income and subjected to 9% tax. So that's a change, or that's a absorption we need to look at. So in this case, although the coffee shop is in the free zone, does not make a difference. The usage of a product and the intention of the product also plays an important role to convert that into a qualifying or not qualifying. Last scenario I'm picking up where I'm supplying those goods maybe to India side. So goods are moving from designated zone to the rest of the world export. So since I'm exporting, I will not at all clear the goods from a customs perspective for a local consumption. So it will be cleared for export. Again, this is a qualifying income. So anything you do within the free zone, which is not meant for a local consumption from a goods perspective, is subjected to 0% taxes. Other incomes are going to be classified under 9%. Apportionment, we talked about how those apportionments are going to work on. We need to wait and watch for, and more clarifications or guidance will wait on that part. Taxable income, I'll just talk about some of the highlight points which covers up the overall ambit of how the broad exemptions or exceptions which are allowed. We have a limited time, so thought of at least giving a high level view of how these things will work in. First starting point is the financial statement, profit and loss. That means any international accounting practices, IFRS is accepted one from that part. So starts from there, which is where take out the P&L. There are unrealized gains and losses is what the question mark came up. Any capital item for unrealized gains or losses, that means revaluation reserve or something equivalent from a capital perspective, will not be allowed. That means you have to readjust the profit or loss which you have taken as part of financials. Whereas from a revenue perspective, there is anything on account of stock adjustment or any kind of a revenue, that profit and loss will be taken into account for tax purpose. So why we are not taking a capital item? Because these are more book profit or a book loss from a capital perspective. Hence, that's not used for the calculation purposes. So you have to adjust it back. One of the point which is important to know, we cannot change the intrinsic capital value also. So that is one part we need to look at. There are going to be some exempt incomes. We talked about participation exemption, that if you are earning more than 5%, you have more than 5% of shares, carrying for more than 12 months, holding it, getting it from a tax-paying country where 9% or more taxes are paid, you will not be paying a double taxes on that part from the UAE side. There are expenses deductions which are not allowed or have a limitations. Expenses in relation to exempt income. So if you have any exempt income, then remove those expenses also. There is a limitation cap on interest, which is 30% of EBITDA. That's a limitation which is being given. So if your interest is higher, then you have to cap it to up to 30%, not allowed beyond that. And 30% is also within the preview and ambit of any RP transaction or any kind of a transfer pricing need to be looked at. Both have to be aligned into. Very specific thing is on entertainment expenses. So business entertainment expenses are there, only 50% are allowed. One part, entertainment is not the only point. We have to look at is the business entertainment expenses. So that's where 50% disallowance is there, and penalties, fines, any recoverable VAT, donation, bribe, anything which is not legitimate. And we talked about some of the examples where you paid the money to a freelancer who does not have a work permit or a working license to operate in the country. Those also may be disallowed, that section. There are provisions where you can even carry forward the losses, and the limit is 75% of the taxable income is what you can adjust for the carry forward losses. There is no time bound or time period being defined till what time we can extend or take those losses forward. Next comes intra-group losses. So there is a provision. There are two points which comes into. One is a group. So you have a provision of creating a group entity. If 95% common ownership is there, then you can create a group of taxes. That means 5 or 6 companies can become part of the group. Certain conditions to be met. Point number one, 95% plus controlling interest is there in the common hands. Point number two, there should not be any company which is 0% taxed in that category, and all the companies should have the same financial year. Now that's again unique from a UAE perspective. You can have the financial year the way you want to. You want to from January to December, you want from Feb to January, everything is possible. So common financial year is also one of the criteria need to be looked at. Second category, if you are not able to form the group because maybe the controlling of 95% is not available, still you can adjust losses from one entity to another entity subject to 75% of the common ownership. So again, there are adjustments points which are being given where losses can be adjusted with another company, which is available. Certain wire rules which are also there. So if you have losses and you transfer the ownership, then the losses carry forward may stop. So that means you cannot sell the losses to a new business. So that's also not possible. Any adjustment of foreign tax credit which is there up to subject to the rate which is being applied and the income being applied. So those are some of the adjustments which can be done from a taxable income perspective. I think what I will do, I will give a pause here and give it back to Janakji for taking it forward.
Thank you. Thank you, Rajiv bhai. Thank you, Rajiv bhai, for going through the various. 1 minute. I need to come to what I want to take. Friends, for the Rajiv ji was supposed to cover various things, but for the limitation of time, he has stopped or not taken certain aspect of it. So now let us come to transfer pricing, area where you all know much better than what we know. But anyway, I will venture into the same. So transfer pricing, as you know, where the transaction is influenced by the relationship with the parties involved, then transfer pricing will come. An arm's length principle transfer pricing will be allowed as far as the corporate tax is concerned between the transaction or arrangement between the related parties and connected person. Friends, let me tell you, various places of UAE commercial company law, UAE corporate taxation law, they have kept the thrust on the transfer pricing, be it the free zone deduction of expenditure, free zone deduction of means 0% tax rate. If you want to take, you need to comply with the transfer pricing regulations. Similarly, when it comes to any business decision, business deduction payable to related parties or connected person, then also TP needs to be complied with. And first and foremost, let me take you through the definition of a related party as per Article 35 of the CT law. They say two or more natural person within the 4th degree of kinship will be taken as a related parties. Now, what is 4th degree of kinship? So if organization is 3 partners or 3 shareholders, then we will have to do family tree of 3 major shareholder holding say 33% of the shares with their spouse, and we have to go there till the 4th degree of kinship. 4th degree will be on the above parents, grandparents, great-grandparents, and great-great-grandparents. Below, of course, will be child, grandchild, great-grandchild, great-great-grandchild. Of course, brothers and sisters-in-law, niece and nephew, grandniece, grandnephew, all are covered. And on above side, uncle and aunt, auntie, great uncle and aunt, great grand uncle and aunt, they are all. So this is a family tree which you need to prepare to come to know which are the related party of the individual. And as I told you, this will be done for, suppose there are three shareholders of the company, major shareholders. So you will have to prepare 6 such family tree, one for Mr. A, one for Mrs. A, then Mr. B, Mrs. B, Mr. C, Mrs. C. So it is very wide. Then natural person and juridical person. So juridical person means company. So then 50% or greater ownership interest if individual is holding or is controlling that corporation, then also it will be related party. What is the definition of control? We'll just see in the next slide. And 2 or more juridical person are also related party if they have directly or indirectly own 50% or greater ownership interest, or they control that another entity and along or together with its related party. So it's a very wide definition of related party. Of course, the person and its P, permanent establishment or foreign permanent establishment, 2 or more person that are partners in same unincorporated partnership, as Rajiv bhai explained to us, or a person who is a trustee, founder, settler, or beneficiary of a trust or a foundation and its related party. So friends, the definition of related party is very, very wide, and it is wider than even IAS 24, International Accounting Standard 24. Similar definition, in my opinion, is there in AS Accounting Standard of definition of related party. So what will happen? What will happen is that you will have to prepare 2 lists of related party transaction. One for the reporting under IFRS audited financial statement, one to be prepared for reporting in the corporate tax return. As we see further along, Article 55, subclause 1 of the article requires, along with the return of income, you will have to declare what are the related transaction with related party and connected person are done. Same as the some form which you are filing in the India as well. Coming to what is control, the control is defined means ability of a person, whether in their own right or by agreement or otherwise, to influence another person, including the 50% or more of the voting right, ability to determine composition of 50% or more of the board of director, and ability to receive 50% or more of profit of another person, or ability to determine or exercise significant influence over the conduct of business or affair of another person. Friends, significant influence is not defined in the law, but IAS 28 defines what is significant influence. Significant influence is the power to participate in the financial and operating policy decision of the investee, but is not control or joint control of. Even if you have power to participate in financial or operating policy decision, you are covered by this significant influence definition. And 20% or more of voting right. If you have a 20% or more of voting right, it is assumed to have a significant influence. Of course, friend, these are the definition as per International Accounting Standard 28. And this term is not defined as per corporate tax law. This we have covered. Coming to the payment to connected person. So they are saying the payment to connected person shall be deductible only if and to the extent the payment or benefit corresponds with the market value of the service, benefit or otherwise provided by the connected person and is incurred wholly and exclusively for the purposes of taxable person business. So who are the connected person? Connected person are owner of the taxable person, director or officer of a taxable person, a related party of any person referred to in paragraph A and B above, that is related party of owner, related party of director or related party of officer. These are all covered under the definition of connected person. Friend, this is very, very important because payment to connected person is also to be covered for transfer pricing various things, as well as for when we come and let us see management remuneration, this will be very important. And as I told, officer is a term which is not defined in the corporate law, but corporate officers are high level management executives hired by the business owner or board of director. An example could be organizers, chief executive officer and chief financial officer, president or vice president. Now comes the determination of arm's length principle, which is same more or less, which is there in India. So in determining the taxable income, transaction or arrangement between the RPs must be at a arm's length standard. What are the methods which they have prescribed? And these are very important. One is the comparable uncontrolled price method, resale price method, cost plus method, transaction net margin method, or transaction profit split method. These are the same as given in the transfer pricing guidelines of OECD. But most important thing here is, unlike India, you can apply one or a combination of following transfer pricing methods. So even if you apply combination of any of these 5 methods to prove the arm's length price, that is also acceptable, and this is a welcome change or welcome inclusion for UAE corporate tax. I think in the world there are only 4 jurisdictions which are allowing such kind of combination of transfer pricing methodology to be proved to prove the arm's length price. Now, say for example, any transaction or arrangement you are not able to take with the 5 method, then they are allowing, as per Article 4, that you can go to any other method, which is also there in India also. So where the taxable person can demonstrate that none of the above method can reasonably apply to determine the arm's length result, then any such transfer pricing method used satisfy the transfer pricing price. But whenever, irrespective of you are using the first 5 method or that residual method 6 method, then you need to take into consideration contractual terms of the transaction or arrangement, characteristics of transaction or arrangement, economic circumstances in which the transaction or arrangement is conducted, function performed, asset employed, risk assumed by related party, FAR analysis as we all know, and business strategies employed by related parties while entering into an arrangement. And as Rajiv has already taken, Article 22E requires the adjustment of transaction with RP and connected person while computing the taxable income. So whatever price you made that arrangement, transaction with RP, first you will add back as recorded in the audited financial statement, and then you will deduct whatever the arm's length price. Friends, one more important thing. Unlike India, that if a transaction does not fall within the arm's length range, then authority will of course make an adjustment. However, unlike India, Article 9 of Article 34 subclause 9 makes very, very categorically clear where an authority makes an adjustment to taxable income pursuant to clause 8, the authority shall rely on the information that can or will be made available to taxable person. So unlike India, where assessing officer says or transfer pricing officer says, based on the various assessees which they are there in with him, so based on the TP of another taxable person, and he says that no, you are not, you're paying more to your related party, and therefore I'm adding. But basis I cannot give it to you because it is a confidential information. So here that secret adjustment, as they call it, is not allowed. You authority will have to make made available on information on which they have made the adjustment under clause 8 of Article 34. That leads us to management remuneration. This is very, very important because particularly in LLC company here, these are very, very important for the LLC companies which are here. Management remuneration. So paragraph 7.5 and 7.6 of public consultation document states that we are fully aware that UAE is not going to tax individual. There is no individual taxation in means individual taxation for salary and other benefits. Then there will be entities will be more inclined to pay to the employees or connected person or shareholder owners who are in the management, and therefore authority here will look very, very strictly on this, and therefore RP and determining the arm's length price of a management remuneration will be very, very important, particularly from LLC perspective. Now Article 33 defines various non-deductible expenditure. In that, subclause 4 is very, very critical. Dividend, profit distribution, or benefit of a similar nature paid to an owner of a taxable person is not deductible expenditure. Dividend we all understand, profit distribution we understand, but the major matter is dividend or benefit of a similar nature paid to an owner of a taxable person. These are very, very important terms which is not defined in the law. What constitute benefit of similar nature? However, what point comes to my mind is any appropriation of profit. Any appropriation of profit will be disallowed under section 34 1 4 of the Act. Point to ponder. Of course, there are bankers' views. So here, as I told you, for when the bankers arrive at the profitability of the company, they add back what is the management remuneration paid to owners. So they will add it back to compute what is the profitability of the company. And sometimes these are, you know, in this part of the world where the amount payable to the 51% UAE national partners, they restrict the net profit, last line of the PNL, to what is amount payable to UAE national partners. Say, for example, it is 20%, 80-20 profit percentage is different than the shareholding person. Shareholding percentage is 51-49. Profit distribution percentage are 80 to expatriate, 20 to UAE national partner, which is allowed as per law here. So, and 20,000 is a fixed amount payable to UAE national partner. So companies here will keep the profitability at 100,000, declare dividend of 100,000, 20% is payable to local partner, which will be 20,000, and balance amount of the net profit they will debit or take away or debit to PNL as a management fee or management remuneration. But this was the practice followed up till now. Now, once the corporate tax law comes, moment a transfer pricing regulation comes, this will be in, even if debited to PNL, it cannot be allowed. If it is not at an arm's length price, it will be disallowed under 33(1) subclause 4 under the clause benefit of a similar nature paid to an owner of the taxable person. One more thing, we have already, if the management is done by related party, then who are the related party we have covered? What is the definition of control we have covered? Payment to connected person we have covered. Who are connected person? So then if the management is by related party, then we have to once again satisfy the arm's length principle test as defined under Article 34 and keep everything ready. Now Article 55 of the corporate tax law mention that authority, when you are filing the tax return, you will have to only disclose. Subclause 1 of 55(1) is saying you have to only give what are the details of related party transaction or connected person transactions and their values. And now 55 subclause 4 is saying that you have to keep the working for arm's length principle ready, and whenever authority asks, within 30 days of the same, you need to give all this thing to the authorities. So, and then authority will check whether this arm's length price is satisfied or dissatisfied, and then if required, they will make the adjustment as we have already studied under 34 subclause 8, where the result of a transaction between related parties does not fall within arm's length range. What intercolloid range or they will follow. They have not been prescribed up till now, but cabinet decision will prescribe it, and then authority will make an adjustment to taxable income of the person. Question arises for our mind is there any UAE regulation which provide guidance on a managerial remuneration? Yes, friends. Commercial Company Law 2021, that provides a guidance similar to Section 197 of the Indian Companies Act, 171, which is applicable to public joint stock company. They say remuneration to board members, and they say it will be restricted to 10% of the net profit in one particular fiscal year. So it is restriction is 10% of the net profit. In India, under Section 197, it is 11% of the net profit. And here, once again, they go that in a year of loss, board member may be paid lump sum fee of not exceeding 200,000 dirham at the end of fiscal year. Now, you may say that these are all for the public joint stock company. So therefore, it will not apply to limited liability company, which are akin to private limited companies of India. But here, section article 104, which is applicable to the limited liability companies, it is saying that for all that is not specifically provided in this commercial company law for the limited liability company provision, the provisions of the joint stock company will apply to the limited liability company also. And Council of Minister, based on proposal of Minister, shall issue a decision that include provision to be applied to limited liability LLC companies in case where the provision of the joint stock company are not consistent with the nature of limited liability company. So whatever that decision comes, then only provision of the public joint stock company will not apply to limited liability companies. So in my opinion, as of now, till the cabinet decision under the corporate tax law comes, maybe 10% of net profit could be one of the limited limits which they will prescribe to the BOD, Board of Directors remuneration. But we have to still await cabinet decision on the same. So Article 55 we have already covered, where they need to SSE has to give disclosure containing information regarding the transaction with connected person and related parties. They also needs to maintain a master file and local file, which is as per the OECD standards. And now question arises, will there be different reporting and tax obligation requirement? Yes, that is to support startup and small businesses in UAE. They have given a special relief that the small businesses, which Rajiv discussed, small businesses relief, which they will, based on the revenue threshold, which will be determined, they will not required to give keep transfer pricing or documentation, and they did not comply with the transfer pricing, arm's length price documentation and other tax obligations. One more thing, like in Saudi, they have not prescribed any threshold. That is, like in Saudi, they have prescribed that SAR, Saudi Riyal, 6 million worth of transaction need not be, they need not comply with the TP regulations or documentation. That threshold is, what will be that threshold will be determined and will come to public domain by way of a cabinet decision. But there also, please note that what they are saying is amount is in Saudi also SAR 6 million, but it is at an arm's length price calculation, not the value of the transaction which you have recorded in your books of account. That point needs to be kept in mind. So coming forward to what is the way forward for the management remuneration. First, we need to decide who is doing the management. Owner is doing, related party doing, or connected person is doing, or independent person is doing. If owner is there, then we need to decide whether he is doing any function. If yes, then detailed listing of the functions which are done by them owner, and what will be the commensurate remuneration at arm's length basis. All this needs to be documented. And if he or she is in a board of director as per memorandum and article of association, then whether overall selling as prescribed by article 171 of the commercial company law, that is 10% of net profit, or any selling which will be prescribed by way of a cabinet decision, applies or not apply. If an owner is not performing any functions, he is only taking entrepreneurial risk, in which case owner will be entitled to only appropriation of profit, which is nothing but, and this will be disallowed as per article 33(1)(4), which we have already discussed. Then we need to identify the related party up to 4 degrees of kinship of individual and their spouse, and we need to make a detailed note of their function performed, role, responsibility undertaken, how the company has benefited of their work, and then what will be the commensurate remuneration which can be paid to their at arm's length price to them. So then the comprehensive documentation for management remuneration will be, in my opinion, this is only as per my view and my suggestion, that we need to have key documentation of a key experience of the person, detailed career profile of the person, linkage of that to the company's operation during the year and in future, the role and responsibility of the person, the size and area of operation of the company, performance of the company, performance of the industry in which the company is operating, internal policies, remuneration committee policy or HR department policy needs to be looked into. And this HR and department policy and remuneration policies are there, which are well documented. This policy will show that person did not anyway influence his remuneration, which is based on an independent guidelines. Secondly, appropriately signed agreement between the director or officer of the company and should be there, and it should minimum cover role and responsibility, remuneration which is fixed and variable, procedural and administrative action for non-performance of the duties along with the termination clause, and it should mention appropriately in scenario of loss during the financial, what will be the remuneration. Friends, if these are taken care of, then as we discussed, that Article 33, which is mentioned, 33(6) to be precise, sorry, 34 Article 5, they are saying that contractual arrangement, transaction. So if this contract is there, we will satisfy the 34(5) subclause 1, that contractual term is satisfied. Characteristics of transactions, we have taken care. Economic circumstances. Friend, please note that economic circumstances, that I have a owner who is well experienced and he knows his business. Correspondingly, I cannot take care. And paragraph 2.181, if my memory is correct, 2.181 of OECD guidelines on transfer pricing 22 categorically mention, if the profitability of the company is dependent on the work performed by particular employee or individual, that needs to be taken into consideration while determining the arm's length price. So if the owner experience is such that without that, this company would not have made such a kind of profitability, that can be considered while determining the arm's length price, and this will fit into economic circumstances. Functions performed, we have already discussed. All function roles and responsibility, they need to be mentioned. Then asset employed. Yeah.
Janakji, I thought let's maybe look at summarizing some of the parts, because
Yeah.
looking at the time also we need to.
Yeah. So fine. Only one thing I would like to say, asset employed is nothing but a human capital employed. So that was one point. Coming GAR only, I don't want to take much. Only GAR, I will only say that GAR is applicable as of now. Any transaction or any arrangement which is entered into after 25th of October 2022, the GAR provisions are in place. So whatever business restructuring or anything which we are doing, we need to mention commercial rationale for the same, and the documentation of that rationale, detailed documentation of that rationale should be there to have to properly take into consideration, so that even if authority takes GAR, we should be properly substantiate our restructuring or etc. Thank you. We can take any questions which are there up till now. Thank you.
Thank you, sir, for the very great and kind session, sir. Any questions from the members, please? Either they understood everything or nothing.
Perfect. This is, I think, the first session, so I'm sure a lot of things Indian tax practitioners know it, and lot will come in the time forward.
It's a new for them, a new topic. So understanding the tax implications and implementing everything. I mean, practicality though, it's on a very lesser level. So
Sir, case law तभी खुलता है जब client होता है side पे.
Oh, that's
Yes,
good, sir. We
yes.
got a brief overview of the entire UAE taxation. So we always know, we have an in-depth knowledge of Indian taxation, but apart from Indian taxation, what is going on in other countries, that is very interesting to know.
Correct.
I'm sure, Akshay, see what will happen the moment you see a client which has a base in Dubai or UAE, then you will start where we open up. To be honest, like we need to have an overarching rule or overarching knowledge.
Correct.
But mastery फिर तभी होती है जब client आता है. So that's
correct.
Correct. For can I take 1 minute, please?
Yes, sir. Please. Yes, sir.
1 minute. Only thing for the benefit of whoever are present, I will make suggestion to read the decision of Reddington Distribution Pte Limited. It is under Singapore Double Tax Avoidance Agreement. what constitute fixed place P and dependent agent P. This is a very recent decision of Chennai bench of ITAT, and it is December on November 22. So anybody who is practicing on the international tax and what constitute and how this fixed place P will be taken care. And it is very important for the companies which are operating from UAE. But if the headquarters and everything is done, only the invoicing is done from Dubai, then it may not satisfy the substance criteria, and as Rajiv Bhai was mentioning in his talk, but it will result in the taxation of that entire income in India. So it is very, very important. Reddington Distribution PT Limited, Chennai ITAT decision of 16/11/22. Thank you. Over to you.
Yes, thank you, sir. Thank you for making such a great session for everyone. I guess we will require more sessions in future to understand the laws prevailing in UAE. So, request Paresh sir. Paresh sir, can we have you, sir? Please, can you give us a vote of thanks, sir, to the speakers?
Thank you very much, Janak. And it's
Yeah.
really pleasure to hear you regarding the UAE tax law. And actually, I wanted to meet you tomorrow, day after tomorrow, at your office, because I had joined the session very late because of
No
certain
problem.
other commitments. But I hope that you had done the really super work, very good work. And as usual, since 1990, you are giving the lectures in Jammu Study Circle and enlightening us with the. Also, in the past, you had given the very good lectures regarding the wealth tax, flowchart of wealth tax. It's really very good. So thank you very much for the, on behalf of Jammu Study Circle, to you and Rajiv, Hira. Thanks.
Thanks,
Thank
Rajiv.
Thank you. Thank you for it.
Thank you, sir, for your kind words. Paresh sir, you are in Dubai only?
No, just 2 days back, I landed to Dubai, and I wanted to meet Janak. Today morning also I had discussed with him.
Okay.
So next 15 days I am in Dubai only.
Very wow, very nice. Great, great. Wish you a great trip, sir. Any question from the members? Anyone wants to think?
So many questions with me, but I am discussing with the Janak in the personal meeting regarding the management remunerations. The person has the visa from one company and he is doing the salary or employment from another company, gold visa from one company, qualifying
Okay.
income, free zone company, then outside country, then Janak, you know everything. What kind of questions practically we are facing in Dubai?
That's what Paresh, I was saying. The moment you have a client, you have questions. So
So, Paresh sir, next session you will take, right, for our circle when you come back to Mumbai?
Then I will take the session with the help of Janak. Okay, what to be written in the balance sheet, what are notes to be prepared, and what is the competition, disallowance, allowance, and arm's length price. I think that is a very, very important things for the UAE tax.
Correct.
Right. Great, great. So, thank you, everyone. Thank you, Paresh sir.
Thank you. Thank you. Sure. It will be myself and Rajiv's pleasure to answer all your questions. No, don't worry.
So please let us know when you are in Mumbai. We'll keep a session. How often do you travel, sir, to India?
For myself,
How often do you travel Mumbai?
okay. I travel to Mumbai many times, but in the later part of the year, first 6 months of the year, we are here busy with our audit and professional work otherwise.
Right.
So after June, in month of July onwards, I come. Okay. And November, December, I am certainly there because of my
Okay.
religious commitment as well. So
Right.
that time we can certainly take one more session covering the practical aspect or case studies.
Surely. Yes, sir. We'll plan a session. Rajiv, sir, what about you?
same thing, like once or twice to Bombay. I'm basically from Delhi, so
Oh,
the locations
okay.
are covered.
Okay, okay. Great, great. Thank you, sir. It was very great meeting all of you, sir. Thank you for your experience and knowledge, sir. We would
Thanks
love.
for the opportunity. Wish you all a great evening.
Yes. Thank you, sir.
Thank you.
Conclude the session here, sir.
Thank you.
Thank you. Thank
Thank
you.
you. Thank you very much.
Nice evening to all of you. Thank you.
Bye, everyone. Thank you, members.
Bye.